Americans are running out of money, pandemic savings are nearly exhausted, unemployment is creeping up slowly, and several notable national retailers are now shuttering their doors as consumer spending slows. However, against this economic backdrop, home prices have been surprisingly resilient, and that's good news for older homeowners, but bad news for would-be homebuyers. So what gives? To put it simply, it's weak buyer demand and a steady increase in unsold homes. Now, shouldn't diminished demand and increased supply be pushing home values down? At least that's what I expected. Apparently not, at least yet. Housing Wire's Mike Simonson writes, even though home prices are higher than last year at this time, payments are 6% cheaper than last year at this time. Last year, in the fourth quarter, and then again in May of this year, home buying costs were at their absolute worst. Many real estate professionals consider a housing supply of 6 months of inventory to be a balanced real estate or housing market. That is, it would take 6 months to sell those homes at their current listing price. Today, the supply of existing home inventory is at 4.2 months. That's up from 3.3 months supply this time last year. Today, the average 30-year mortgage rate is 120 basis points less than it was a year ago, which has provided some modicum of improvement in housing affordability. In addition, relatively stable mortgage interest rates have removed some pressure from home sellers who had found themselves caught off guard in 2022, and that led to a spike in price reductions. Now, all things considered, 2025 could be shaping up to be a year of relative housing stability for the real estate market, which is good news for both reverse mortgage borrowers and originators alike. Now is the time to uncover potential borrowers' most pressing concerns about retirement and cash flow to see if a reverse mortgage could, in fact, help improve their quality of life. Housing Wire's Chris Clow reported last week that leaders of equity sharing companies have been promoting that their products are unique from reverse mortgages, largely because they say they are not debt-based instruments. But plaintiffs in one case have argued to the U.S. Court of Appeals for the Ninth Circuit Court that such equity sharing arrangements are in fact a loan, at least under Washington state law. The plaintiffs also say that one company in question is now not operating under the regulations that govern reverse mortgages in the state of Washington. The case originally brought in Washington state court is now playing out in the federal court. Plaintiffs Charles Boyd Olson and Janine Olson, who reside in Kent, Washington, and also a Seattle resident, Maggie Cohen, say they entered into a Unison equity sharing agreement in 2019, with the understanding that Unison's product was not a loan. Just a quick note. In March 2023, we reported on this show that ClassAction.org was asking residents of Florida, New York, and Ohio who have entered into an equity sharing agreement with Unison to contact them. Now, apparently that was the first sign of potential legal action on behalf of homeowners. The initial legal complaint alleges that Unison's offering meets nearly all of the criteria for a reverse mortgage loan and functions as a reverse mortgage. That would subject it to Washington state law, which regulates those loans. The Olsons are facing financial challenges due to life circumstances, and they were seeking a way to help cover their expenses. So they sought out a Unison flyer, and it described their product. Now, the flyer said that the Olsons could access the equity that's locked in their home by entering into an agreement with Unison, which would include no monthly payments and no interest, that according to court documents. But when contemplating a home sale and also their other financial obligations, the Olsons had to conclude that they would receive very little proceeds if they paid back their loan to Unison, and they have remained in the property since. Plaintiff Maggie Collin asserts that after entering into an agreement with Unison, she later realized that the agreement had prevented her from refinancing her condo, according to the initial court complaint. She was allegedly informed by Unison that terminating the agreement would require hundreds of thousands of dollars in payment to the company. Now, of course, that would make sense with the accrued payoff, but Unison contests the characterization of their product, saying that the product is an option, but not a reverse mortgage. They also claim that the plaintiffs have created a term to describe their agreement, an equitable reverse mortgage loan, which Unison asserts has never been used in the annals of American law. This case was ultimately remanded from state court to federal court, and this week a 3-judge panel for the Ninth Circuit Court of Appeals heard oral arguments from both sides. Attorney Thomas Scott Railton made the case for the plaintiffs, telling the panel that Unison's product violates Washington law in 3 ways. First, that it is a reverse mortgage under the state's Consumer Loan Act. Second, if the product doesn't correspond with that law, then it fails under the CPA through conduct that poses the same kind of risks as regulated conduct, but inadvertently evades regulation. Attorney Thomas Scott Railton made the case for the plaintiffs before the 3-judge panel, saying that Unison's product violates Washington state law in 3 ways. First, that it is a reverse mortgage under the state's Consumer Loan Act, or CLA. Second, if the product doesn't correspond with that law, then it does fall under the state's CPA through conduct that poses the same kind of risks as regulated conduct, but that inadvertently evades the regulation. And here's what the presiding judge, Daniel P. Collins, said in response to the defense's counterargument. Here's the problem I'm struggling with your argument, which is that if you look at the definition of a reverse mortgage loan, it has all these particular features that are listed, and you have all of those. And then you want to say that the general term credit obligation actually limits those terms further. Now, this case could set a very serious precedent for other equity sharing companies and could curtail the offering of these products. We'll be keeping you apprised of that ruling and be watching it very closely. The top concern among baby boomers may surprise you. The 10th annual John Hancock Financial Resilience and Longevity Report found that 57% of baby boomers are worried about the upcoming election, followed by inflation, cost of living for 47%, economic conditions for 37%, and retirement savings for 32%. Now, those statistics may surprise you, but consider the following. Baby boomers own approximately 52% of all the wealth in the United States, despite only accounting for just 20% of the population. Of course, boomers have had several more decades to accumulate wealth throughout their working career, which also housing wealth does play a significant role. In a recent post, NORMLA VP of Communications Daryl Hicks summarized some of the notable takeaways from the Hancock study. First, 60% of boomers feel they have their debt under control and have adequate emergency savings. Second, boomers plan to retire on average at the age of 67. Third, 53% of boomers are worried about covering future medical expenses. And fourth, something reverse mortgage professionals should note, more than a third of baby boomers do seek professional help with their retirement and their planning needs. In other words, if you want to work with a more affluent homeowner or someone who's not just merely a needs-based borrower, you'll likely need to be engaging with financial professionals in your area. Thank you for joining us for this week's episode of HECMWorld Weekly. We do also have an audio edition, which you can find on Apple Music, Spotify, and on Podbean.com. Be sure to subscribe to our YouTube channel and go to HECMWorld.com and hit subscribe there. That way you can stay up to date on all of our latest breaking content. Thank you for joining us, and be sure to return next week for the nation's only weekly podcast, bringing reverse mortgage news to you, the mortgage professional.